Hello and welcome to this episode of Capital Call, a special podcast series on how venture capitalists are looking at the world post-COVID-19. Today we have with us Anup Jain, Managing Partner at early stage VC firm Orios Venture Partners. Welcome, Anup.
Also, how is it, when it comes to your portfolio companies, I'm sure that, the amount of interaction you would have initially with them, probably mentoring them, troubleshooting with them, that has kind of gone away from the physical touch point perspective. So
there are, different portfolio companies which require different kind of discussions. Could be around business strategy, could be around funding, could be around execution, could be around steps to take during this lockdown. The most, obviously, I would say at this point of time, immediate questions get addressed first, and companies which would have a shorter runway, they would appear high on concern for every investor at this point of time, and therefore they will receive a higher share of attention.
Got it. So also considering that some of your portfolio companies might be in need of a follow-on round, what advice are you giving them in terms of early investor? Are you asking them to take bridge rounds? What are the valuations?
So firstly, I think money to survive is always welcome during a tough phase. This is indeed a tough phase. Money for growth comes later after money for survival. If there are companies which are needing some bridge rounds, then as an investor, we are happy to extend some of our support, which we would have done in any case in the subsequent rounds. And it goes without saying that the most deserving companies who are closer to product market fit, amongst the best teams in terms of execution, strategy overall, and have the best chances to raise the next rounds, will obviously get an unfair share of our support at this point of time. So I think we're doing a combination of also helping them with conversations. In terms of valuations, I think flexibility at this point of time is a wise strategy for any of our companies, who are having a investor in front of them, willing to make a sizable investment, which means they're both short-term and long-term needs. Yeah. So I think we would advise some element of flexibility here.
Do you think that it is advisable for the portfolio companies in dire need of capital to take those kind of cuts to valuation to bring in external investors? If not, are you looking at deploying your existing share of capital to see them over this phase and probably then ask them to initiate the next round of funding?
I think you bucketed the companies into two. One is companies which are in dire need of cash to be able to survive. I think such companies would have initiated fundraising much before Corona, right? And therefore they would have experienced some feedback on their efforts. So if they have not managed to raise funds so far, it seems that prima facie there is lesser appeal because of a variety of reasons for them to be funded. And in that case, if they are receiving a positive interest from a follow-on fund to make a decent size investment which can help them survive, I think we as investors as well would be quite happy in supporting the founders, taking either a flat or a dip in the valuations to be able to lengthen their journey. In case of companies, however, which are having larger runways of, let's say, maybe 12 months or more, those companies can wait patiently, barring certain sectors like global aviation, hospitality, offline, discretionary spend retail, in which we have lesser investments, thankfully, as a VC in our portfolio. I think the balanced sectors are going to see a gradual resumption of normalcy. Companies with a longer runway, they don't need to necessarily overfund themselves. They must be planning to start their fundraising process maybe 3 months down the line in any case. And within those 3 months, we do expect a resumption of normalcy to happen, particularly India's past track record.
In our last conversation, I remember that you were interested in talking about new breakout consumer brands which were coming up, and there was some interest in a couple of companies which you were evaluating. Those brands would have taken a hit, right, in the current scenario, and how are you managing that portfolio?
I think from the last time we spoke, we were indeed looking at direct-to-consumer brands in the FMCG space. However, we have only made one investment so far, which is in that space, and that is Country Delight. And this is into milk and dairy products, fresh and pure, delivered to your doorstep. They have since then expanded their portfolio into bread and now recently introduced eggs as well. So companies like these come under essentials, and their business is actually booming. Similarly, we have Beto, which is a health tech company into full stack diabetes management. We know that during Corona, consumers with underlying comorbidities like diabetes and hypertension are at higher risk. So we are seeing greater engagement and greater usage of this platform by current users of their devices as well as the entire platform. So I think overall in our portfolio, we have some of these brands which are positively impacted during this Corona period, and I think they're rapidly jumping to that opportunity. Another example is Gully Network. This is a chain of branded offline kirana stores which are now enabled through technology. Gully Network manages the entire end-to-end for these stores, and therefore the store owner is able to service his customers really well, with supplies being taken care of by Gully Network. So I think these are different examples of companies that we have invested in our portfolio where they all come under essentials. They're consumer retail or consumer FMCG brands, and they have been luckily positively impacted during this period and doing their best to serve consumers.
Got it. And also going ahead, do you think that, this current situation would probably in any way change your investment thesis? Are there any particular sectors which you think you would start looking at more closely?
Yes. So I think as Orios, we've always believed in investing in tech-enabled businesses because technology enables mass personalization at a low cost. And India, being a country of 1 billion plus people, even smaller cohorts of consumers with which you can do business tend to be in tens of millions. So the way to address such a market with high technology and at a low cost is only by investing in businesses which are enabled by technology itself. We will be looking at sectors which, with a filter of whether they come under essentials or discretionary spending. As you know, every investor has a limited fund life over which they're supposed to give returns to their investors. The impact of COVID on the global economy and indeed the Indian economy is very clearly going to be that of a slowdown in discretionary spending. So therefore, it makes sense to apply that filter while investing further of whether a company is going to be addressing the most essential needs of consumers over the next 2 years. They'll have a better chance of survival and getting funded versus companies which are going to be betting on discretionary spends because discretionary spends are definitely going to go down, and irrespective of socioeconomic strata and otherwise. Areas like travel, hospitality, aviation, wealth management, these might also see a dip. I think we have a real opportunity in the country to come up with education businesses which are going to address the needs of so many of our children who would be happy getting that access through technology. So even productivity applications which help you to utilize your time and help you to use technology better on your phone, I think those will also be of significance, and many consumers will be very happy paying for such applications so that they can use their devices much more. and much more securely as well. So cybersecurity is also going to be an important thing. I think health-related businesses are going to be definitely seeing an uptick. Consumers have, picked up immunity as one of the key words of this COVID syndrome. So everyone is now going to be focusing on, let's say, nutrition. Far more, more importantly, health and wellness is going to be in focus for the entire family. So if there's any discretionary spend, I think it will find its way into, let's say, education, technology, electronic devices, which help you to access and do more and more things sitting at home. Also, I would expect health and wellness to be center stage. I think going forward, one would look at, continue to look at gaming sector. Home-based entertainment is going to grow. There could be dialect-based entertainment platforms for consumers, not just living in the top cities, but beyond that. There could be a surge in mobile gaming. We saw that in China. It has been seen in the US. In fact, we recently invested at the seed level in a company which is into real money quizzing called Zupi, which then got funded later by other investors as well. So I think these are the various areas and some of the filters that we will put our scrutiny through to arrive at the best bets in the coming years.
Wanted to understand that would this also change the entire thesis about investment in general, that it might open you up to more co-investment opportunities, or so to ensure that there is a follow-on round coming?
I think at Orios we have been great believers in terms of co-investing, and you're right, it helps to mitigate risk, and many funds see it as both mitigation of risk at the thesis level, because you get better validation by having another group of minds look at what you are positively inclined towards and say a yes to that. Also, the latter part of the journey for fundraising for the startup also gets much better supported than if you were the only fund who was supporting them. That goes without saying. So I think we will continue to look at co-invest. We're already co-investors with over a dozen funds.
To get some perspective, Orios last raised its corpus in 2015, right? And post that, have you been looking at a fund, raising a fund as such? And if so, how are those conversations turning out?
So we are investing out of our second fund, where the final close was 2018. We've invested in over 20 companies so far, and there is room for making some more investments. So we are looking at making those investments over the next 6 to 9 months, maybe, and then continue with pro rata funding. We are also at this point of time raising a select fund which invests into winners from our past seed funds. And here the conversations are going on positively. We have already done a first close with investments in a few of our winners like Go Mechanic, Country Delight, as well as Farm Easy. So we look forward to completing this fund over the next year or so, maybe sooner. Given the post-COVID scenario, we'll see how it rests. So I think funds like these are largely protected in terms of returns because they are by definition investing in winners. And they're doing Series B plus rounds, so the companies are more stable, dominance of market share, etc., and model and teams are all well established. And consolidation, etc., if anything in that segment would have already happened.
Thank you for those insights, Anup. Hopefully, the activity will pick up in next 3 to 4 months, and we will see a lot more new business models as well as businesses which focus on the digital world. Thank you for listening.